Amazing reliability of candlestick patterns. Just because a particular pattern signaling a reversal of trend emerges, this doesn't mean that the predicted move is real. While some Japanese candlestick patterns are more reliable than others, no model is completely foolproof. That's why it is important for you to look for confirmation with other technical analysis tools. When multiple indicators predict a price change, this increases the chances that the market will perform as anticipated. Short-term trading on any market is risky business. You have to interpret all the complex information constantly thrown into the mix and keep your emotions in check at the same time. Skills such as accurate interpretation and fast response time can be learned. Controlling your emotions so you can limit potential losses is an ability that comes with experience. Trends and patterns. Context. It is not enough to simply identify a trend. Each candlestick pattern must be placed in context, otherwise you may misinterpret their meanings. You need to know where the turning points are. Highly reliable Japanese candlestick patterns will tell you when a particular trend begins and approximately when it will end once the move is near exhaustion. You should see some sign that the price momentum is slowing before a potential reversal takes hold. The ability to recognize these points is particularly useful in swing trading. Former tops and bottoms of previous trends on the chart tend to be strong support or resistance lines. Trading that breaks through these support and resistance lines can be another reliable indicator that the current trend will continue. However, these same points may also be junctures where the trend could reverse. You are probably already familiar with the kicking pattern, abandoned baby, morning star, morning doji star, piercing the line, 3 inside up, 3 outside up, 3 white soldiers, and their counterparts. Here are some additional highly reliable Japanese candlestick patterns described in context. Rising windows. This is a 2-day gap formation that indicates a short-term bullish trend will continue. It is simply a gap in trading between 2 days. The gap becomes a critical support price range. It is only valid if the lower shadow does not meet or overlap the upper shadow of the previous day. Most gaps eventually fill, so the price will likely return. However, this pattern still indicates a trading opportunity. It can't take a long time for this type of gap to fill if it isn't filled quickly. Falling windows. This is a 2-day gap formation that indicates a short-term bearish trend will continue. This gap in trading between 2 consecutive days can happen anywhere during a downward trend, including the reversal point. The gap becomes a critical resistance price range. It is only valid if the upper shadow does not meet or overlap the lower shadow of the previous day. Note that new support and resistance lines are generally tested within a few days, but the trend will generally resume after that test. Windows will mark the critical support and resistance level, possibly for months to come. So, these gaps in Japanese candlestick patterns are relevant for future trades as well as the current one. Upside gap to close. This is a highly reliable bearish 3-day reversal pattern. In an uptrend, a long wild candle forms. The second day gaps up substantially and forms a small, black-bodied candle. The gap remains unfilled. The third day engulfs the second day with another black candle but still closes above the trading range of the first day. Above the stomach, this is a bullish 2-day pattern. In a downward trending market, a long black candle forms. The second day opens above the midpoint of the body of the first day's black candle. It forms a long wild candle that significantly breaks through and closes above the top of the previous day's trading range. Below the stomach, this is a bearish 2-day pattern. In an upward trend, a long wild candle forms. The second day opens below the midpoint of the body of the first day's white candle. It forms a long black candle that significantly breaks through and closes below the bottom of the previous day's trading range. Bullish concealing baby swallow. This is a 4-day reversal pattern. The first 2 days are black Maribosu long candle with no shadows that followed a downward trend. The third day gaps down in the opening but trades up into the body of the second day. Then, the intraday trading reverses to close below the opening, forming the third black candle. The fourth day is another long black candle that completely engulfs the third day, including its shadow. Ironically, these bearish days create a reliable bullish signal in this Japanese candlestick pattern.